Your paycheck gets sliced before it even hits your bank account. Billions of your hard earned dollars are funneled into corporate bailouts, foreign conflicts, and pet projects for social interest groups. See, you aren't just funding infrastructure, you're underwriting a political elite that gets rich off your labor while you struggle to pay for groceries. Low income households spend 33% of their money on total food items. Middle income households dedicate 12.2% of their income to food expenses, and highest income households spend only 6.4% of their income on food. Welcome back to the Tyshon Brown Show. And today we're breaking down the data on the earnings, spending, and where we are headed as Americans. Now, when evaluating overall tax burden, Hawaii is generally ranked as the state with the highest total tax burden in the United States, with residents contributing nearly 14% of their personal income to state and local taxes. Alaska has the lowest overall tax burden in the United States, representing approximately only 5.36% of residents' personal income. Alaska is one of 9 states with no personal income tax, no state level sales tax, and maintains below average property taxes. No income tax states includes Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. Lowest property tax states. Hawaii has the lowest effective property tax rate, 0.29%, followed by Alabama, which is 0.37%. Lowest sales tax states. Alaska has the lowest combined state and local tax average, 1.82%. Delaware, Montana, New Hampshire, and Oregon impose no state sales tax. Now, let's break down the history of income tax in America. You see, the modern United States federal income tax officially began on February 25th, 1913, following the ratification of the 16th Amendment to the U.S. Constitution. This gave Congress the legal authority to permanently levy taxes on incomes. In 1861, the very first U.S. income tax was enacted as an emergency measure by President Abraham Lincoln to fund the Civil War, but it was later repealed in 1872. Repeal means cancel or revoke or policy that is no longer valid. In 1913, the 16th Amendment was officially ratified on February 3rd, 1913, and the Revenue Act followed shortly after, setting initial tax rates of 1% on net incomes above $3,000. In 1943, though, the modern tax system, which features payroll withholding directly from employees' paychecks, was introduced during World War II to make tax collection more efficient. You see, taxpayers' money directly or indirectly funds millions of Americans, primarily Social Security recipients, Medicare, Medicaid beneficiaries, federal and state government contractors, and households receiving public assistance of tax credits like the Earned Income Tax Credit, better known as the EITC. Tyshon, let's get to the good part. Let's get to the part where the rich get richer. Okay, here it goes. Wealthy individuals do pay taxes, but often at lower effective rates than middle class earners because their money comes from investments rather than traditional wages. The tax code taxes income from labor, but grants massive structural advantages to income derived from wealth. The wealthy minimize their tax liabilities using several legal strategies, such as unrealized gains. Most billionaires' wealth is tied up in assets like stocks or real estate. Under the law, this increase is not considered income and it is not taxed until the assets are sold. The borrow, excuse me, the buy, borrow, die strategy. Instead of selling assets and triggering capital gains taxes, the ultra wealthy use their assets as collateral to take out massive low interest bank loans. Because loans are not legally defined as income, they are entirely untaxed. Lower capital gain rates strategy. When wealthy people, when wealthy individuals, they do sell assets, the profits are taxed as capital gains rather than standard income. You see, the maximum capital gains rate is significantly lower than the highest margin tax bracket for regular wages. Business deductions strategy. The rich often own businesses that allow them to heavily offset their taxable income by writing off personal expenses, taking depreciation deductions, and utilizing pass through business structures. Low salary strategy. Business titans usually take nominal salaries, often just $1, and instead receive their compensation entirely in corporate stock. You know? Allowing them to legally report a very small taxable income on paper. The history of the American tax code proves one thing. It was it wasn't written to track your income. It was built to reward ownership. While most people are trading time for a paycheck and paying the highest tax brackets, the wealthy are playing a completely different game, using real-world deductions and low capital gains to stock their wealth. Stop playing the game and start learning the rules. Thank you for watching the Tyshon Brown Show. Don't forget to hit that subscribe button, drop a comment with your thoughts, and I'll see you next time. Peace.